Okay, in this episode, I'm going to talk about the Long Straddle. And the format that I put these into are, first of all, what were my expectations that led me to using a long straddle? The second thing I'll go through is other strategies that most people would probably use because they're not available or not familiar with options and some of the things that the opportunities that they give you options, right? So the third thing is that I'll go through in this format is I'll give you the long straddle and how I set it up, and the fourth thing is what considerations went into coming to the conclusion that I would use a certain stock or indice or ETF or whatever, and take a look at some tools that you might be able to use that might help you in looking at a long straddle. So the first thing is my expectations. So these expectations are for June 6th, 2022, and the market's kind of been going down a little bit. It's been going up some, directionally. I'm not sure where it's going. So right now, my mindset is that I'm 65% bullish on stocks. I'm 35% bearish, and I'm not neutral at all. So in other words, my expectations are the market's going to really go up or it's really going to go down in the short to mid term. And so how can I take advantage of that? Is leads me to what my strategies are available. So in this second part, as far as strategies, obviously you can just hold cash. You can do one directional things like calls and puts on a particular stock or the underlying, as they would say, and or you can do short a stock, but then there's margin involved and those types of things. So none of those really fit for what I'm looking for. And so I go to the long straddle as the selected for at least my current thinking, and using a long straddle allows me to gain really on both ends. So if the stock goes down, I can profit, and if it goes up, it can profit. It's not going to profit remain neutral, but like I said, I'm not neutral on this particular at this particular juncture as I look into the future. So the long straddle is basically made up of two at the money, a call and a put. And the at the money call, just kind of go through it here. I would buy one call for $6.37. And you can see it's at the money. The price right now is running around $308. And it could be on either side. There's really doesn't matter. It may save a little bit going one way or another from the 308. But let's just take the 308 strike price and then the 789. And so now we have a price of, let's just say we'll put it in at $14.12. So what does this mean? So let's just kind of take a look at what the profit scenario looks like. So because it's $14.12, the 14.12 with it currently trading at about $308, the break-even point is $322, and the other break-even point on the low side is going to be $294. So really, we will profit if it moves between, let's say, 294 and 322. And we'll talk about that a little bit more under considerations. But right now, that's in essence what the profit scenario looks like for this long straddle. Now, one of the things that I did, and today's June 6th, I looked at the I looked at the options for June 17th. But if you'll bear with me here for a second, you look at, let's say, something out a little bit. Let's say we decided to go with the July 15th. So let me delete that real quick. And we do a 308 at the money call and a 308 at the money put. And now we're looking at about $24 for that particular scenario. So if you remember the first one we did for June, coming up in a couple weeks, it was only $14. Now we're looking at $24. So it gets more expensive as you go out in time frames for the expiration date, because it gives them more time, obviously, to move around. So that's $24 each way. So $24, we'll look at the profit scenario. You're looking at 308. It could go down to 284. And it can also go up to 332-ish for the profit before you start to realize that profit and everything else would be a loss, but it's a scaled loss as far as where you are in accordance with 308 from that triangle. So this to me is, if you're confused about whether the market is going to go up and down, or up or down, and but you're not really neutral, you really think it's going to move one way or another, you can profit from either side of it. And to me, an option strategy like this makes a lot of sense, for me at least, at this time frame. Now, you may have a different expectation. That's why I wanted to share what my expectations were before I started deploying some of these in recent weeks. But so the fourth thing is considerations. So the first thing I do when I'm going through and I'm looking at a particular stock is the open interest. And you can go to optionistics.com. It's just a place where I go and I can look up, here's the triple Qs that I just used. See, there's a lot of open interest. It's the third largest other than the S&P indices, but there's 11 million open contracts under the triple Qs. So I don't really have to worry about my order getting filled either when I open it or when maybe halfway through till expiration I want to sell it. I don't have to go around looking for a buyer for somebody, because there's a lot of people trading in it. And this is one of the considerations that you want to have is what is the open interest? And I typically trade higher open interest types of underlines, and an underline again is just a stock or an indice or an ETF or whatever it is that I'm trading. So that's one of the first things that you have to consider. And then the second thing is what is the volatility of that particular stock? So I go to this volify.net. It kind of gives me a sense of, because when the volatility is high on a particular underlying, then what happens is you're going to be paying more premium, just as like when you go out in time to expiration, the premiums go up because you're allowing for more time. When things are very volatile with options, the premiums for those options go up also. And so the strategy associated with it, it's interesting. You'll have different people tell you different things in YouTube, and you kind of have to, and other places too, and books that I've read on where do you, how do you use the long straddle? Well, you might use the long straddle. Someone will tell you when the volatility is rising. Now, what does that mean? Sometimes they are not clear, and sometimes that could mean the VIX, which is associated more with the S&P index, is rising, which is just telling the volatility of that. And if it's rising, then it's a good time to buy it because the premiums are lower associated with it. But I found that when there's a lot of volatility out there, that this strategy works either way. But the thinking of paying for a lower premium first than when the VIX goes up. But typically the VIX is going up when when the stock market's going down. That's not 100%, but it in general moves in those particular directions. But so when I go in here, I can look at the triple Qs. Let's just see what type of scoring it has. You can see it's not its implied volatility is 30%, but its rank, which I use quite a bit, is 62, which is a bit on the higher side. But it's just one of those things that I feel is going to remain volatile for a long period of time. And even though I might be paying a little bit more in premium, that it kind of fits my eye. Now I'll use this more when I'm trading other types of strategies, but I'm not going to get into that here. The other thing is time decay. So as time goes by and you get closer to the expiration date, then the profitability starts to disappear. And let me show you. There's a site. It's called option profit calculator. Just put it up here. You can go to options profit calculator, and then I can just pull up a straddle, and then we'll go back to the Qs. So I'll put in the triple Qs in here. It'll get the current price, and then I get to select the call price. So it's trading at 306 or 7. You can see that, and at the money would be 322 for one contract, or $322. And then for the put, for a 307 put is let's say $3.27. So the spread is $6.49. Now this is for a time period for June 8th. So that's like 2 days away. So it's not necessarily a super great example. So let's just kind of go back in and we'll look at something maybe 90 days or more out. And so let's look at September 16th, and we'll change it. Now you can see some things here going on with the increments, but we can do a call, one call for September 16th for $20.91. And as you can see, the price goes way up. If it's expiring 2 days, $3 and change. But when we go out to the 16th, it gets a lot more expensive. And so let's look at the 305 call or put for 1831. That completes both sides of the straddle. And then what this will do, as you can see now, that's $39.22. So this is one of the things about straddles too, is they are expensive, and they can get more expensive when volatility is high. So let's just calculate here, and this is one of the things I do like about this particular site, is you can see here's June up in the calendar here, July, August, and then the expiration date. And what you'll see is, it needs to move. So it needs to go from 305, up to 321, 324. And you can be in the money pretty quickly even in June, but that's still a sizable increase, or it's got to fall quite a bit down there. So I don't know whether I would do the Qs based on this. That's a pretty expensive, especially going out that far. So I'd be looking at this, maybe looking at some other types of underlines that I could that might represent what it is that I'm trying to accomplish. But I'll be honest with you, 305, will it be something lower or higher in the next 3 months? I'm pretty sure that will it be that much. I'll have to think about that a little bit more. but then I would go back in and say, okay, what's this say? Yep, that's what I want to go with. I could go back, I can review how much this one, and this is for June 17th, so I probably, oh no, this one's for July 15th. Would it move $24 either way? Uh, you know, from my perspective, it could definitely do that, or at least move enough early that it will allow me to take some profit off the table, and maybe I can reset it, because as the price typically, it would say if it moved up, then the price of those of the cues for my premium that I'm going to pay is going to continue to go down. If it goes the other way, then the premium may go up. So they work against you one way or another. But again, I think beyond the description here, I think I more want people to get a sense that this is a tool or a strategy that they can use that allows you to profit either way. You just have to have your expectation that it's not going to stay where it is. And nobody knows the future, but again, with all the volatility we've had and all the things going on with the Fed raising rates and all those types of things, I believe the volatility of the some of these indices and some of the ETFs and individual stocks is going to continue to move pretty wildly, and it offers an opportunity for the straddle to be something that you can take advantage of. So anyway, that's it. I'll separate this out into the four chapters that I talked about. So I'll have the expectations, the strategies, the selected strategy, which in this case is the long straddle, and then also the considerations that you may want to look at as you go through. And you can obviously go back to some of the tools that I used here, the different websites, to kind of take a look at it, get a sense of it. But that's what I wanted to cover. The one thing I probably did miss is what's the ideal time frame for this. I think I may have mentioned in there that typically, and again, I've seen everything. Some people do it for 2 weeks before expiration date, and because it's a cheap your premium that you have to pay is cheap, and buying the call and the put, but it's got to move, and I don't like theta working against me that quickly, the time, because I'm too close to the end. So again, I typically will look at 45, 90, 100 days out in order to use this particular strategy. So that's what I wanted to cover this week. If you're not using strategies or options, it can be a little intimidating. You can also lose money, but you can lose money just buying stocks too. But I think it's something that people should educate themselves on, because again, if you're just going to buy, I don't believe that buying and holding stocks for a long period of time is going to work moving forward. That's just my opinion. You may disagree with that particular opinion, but I see some really scary things coming up, and I'll talk about that in other videos. So I hope this was helpful to you. I will put links. I don't do training on the basics of options, but what I will do is put links to other people who have done a really good job of doing it. There's no reason to reinvent the wheel. If I can do something better, I'll do it. But I think I'll wind up putting links in below on the information tab below, and you'll be able to watch videos if you're new to options, those types of things. I think it's something you should educate yourself on, even if you got somebody else manage your money, to know what tools are available to you around your finances. I think is an important thing to do at this time. So thank you, and remember, there's always a better way.